We've released a new version of our software, and when you go to log in, it will pop up a screen that says, do you wish to automatically upgrade? Hit yes, and it will automatically upgrade to our newest version. And there's a lot of new tools in the last few versions. I haven't been doing what's new videos. So one of the new features under chart examples is our currency indexes. And basically this is showing a chart of each individual currency, a dollar index, euro index, yen index, pound index. And it makes it really easy to visually and immediately see which currencies are strongest, which ones are weakest, and also what I like to call event-based trading, which is when a currency breaks out over its previous day's high or underneath its previous day's low. So you can see the dollar index. I'll make this bigger so you can see it a little bit clearer. The dollar is kind of going sideways, and it breaks out from underneath to above its hourly moving average, and also breaks out above the previous day's high of the dollar index. This is an event that is likely to make the dollar continue to trend. When the market's chopping around and going sideways, which you can never really tell in the past using our statistical trend tools, now by actually seeing a chart of the dollar, you can find all kinds of patterns. You can use trend lines on it. If you hold your shift key in when you draw your Fibs, you can see Fibonacci profit target levels of the dollar. After a market makes a big move up, it's very likely to reverse somewhere between the first and second Fib target, which you can see it did. And these are all the things that you can kind of spot using the dollar index, the yen index, and so forth. If you have another currency that's weak, like the pound is, you can see it was going sideways, and around 4:30 broke down right here. It was already underneath its hourly moving average. It was not able to go above the previous day's high. So basically you want to sell the pound dollar, and that's basically how you use the indexes. And I've been going over these in our blog for a while. Let's go over some of the enhancements in this latest version. We've had the FX trend intensity for the last few weeks, and it is, I think, one of our better statistical trend tools. So there's some new options for the FX trend intensity, but I'll put it on and show it in its old format. Basically what this does is it lets you see how strong or weak each currency is compared to all the other ones. In other words, we compare the euro to every other currency, the dollar to every other currency, and this shows how strong or weak it is. Typically levels of 40, the trends will continue, and anytime you see a plus 80 trend, it almost always continues. So let's just take a look earlier at some of the other currencies. Big strong dollar Swiss trend right here, and you can see it goes up with a lot of momentum, sideways, up. And notice how anytime you have a peak of strength and then the pullback phase has very little amount of weakness, that trend's very likely to continue. What's new in this is you can now click on Oscillator, and instead of displaying the information like this, it displays it like our new Perfect Oscillator, and it lets you see the moving average of the statistical strength or weakness, and anytime the digital signal processing base moving average is above the zero line, the dotted gray line in the middle, you're in an uptrend, you're looking for buys. When that moving average is underneath the zero level, which you can see it happened right here, you're basically looking for sells. And it's a very useful tool because we use very fast digital signal processing based moving average. This is not a simple moving average, it's not an exponential moving average. It is the same type of technology that's used to clean up digital signals. And it's very fast, it's also very smooth. And not only do we plot the moving average of the FX trend intensity, but we're also plotting the Bollinger Bands of those. And anytime you see those get narrow, it means volatility is kind of getting smaller, and you're likely to have a breakout, like right here, right here. The market fell down a little bit right here. The market shot up right here, low volatility. The market made a big move down. And that's the markets go from periods of trending to consolidation. And anytime these bands get tight, you have a decent, very clear sign of consolidation. And another way of using this is if you see an uptrend here, you can look for buys when the FX trend intensity comes down and hits the lower Bollinger Bands right here. And notice it goes up. As long as the trend's up, you get a pullback right near the lower band. It went up, pullback. It actually went underneath the lower band, so that's a sign that the trend might reverse. You don't know if it's going to continue up. And you can also use these to kind of get out of trends. If you're in a trade and it's kind of going up and it pulls back underneath the band, you can get out of that trade there. Notice it pulled back to the 0 line right there. That's how you use this tool. Now, one of the new features that we put in is what I like to call the Perfect Oscillator. And it took me a while to come up with a name for this, but it is a perfect oscillator because it doesn't use number of periods. Most tools, like let's say the stochastics or the MACD, I'm just putting these on there, I hate these tools, they have a period. And anytime you have a tool with a period on it, when the market goes one bar into the future, what happens 14 bars ago, if it's a 14 period one of those past bars falls off, and that can change the indicator value. Ours doesn't use that. Also, like stochastics and many other indicators, they show overbought, oversold, and they give way too many signals. Look, overbought, oversold, overbought, oversold, overbought right here, and it continued up for another almost 100 pips. Ours only shows extreme overbought, oversold right here. It's up too much, and the market kind of goes sideways for an hour. Right here, it's at an overbought level, and it goes up another 3 bars and then goes sideways for 2 hours. Right here, it's oversold. Guess what? It reverses. Right here, it oversold, and it's oversold. Now, if you use their indicator to sell the overbought and buy the oversold, you know, you're occasionally going to make money in the sideways choppy phase, but when the market starts to trend, you're going to get killed. You go short right here, and guess what? You just lost 100 pips. You know, for that reason, it's kind of worthless, and that's why I don't like it. Our Perfect Oscillator does not use periods. It uses statistics, and there's so many ways to trade with this. Let me just show you what I like. We also have the moving average of my Perfect Oscillator and also the Bollinger Bands plotted around that moving average. So when the moving average is above the 0 line, the trend's up, and a lot of times when you get pullbacks like this, notice the pullback is right at the 0 level. That's very high probability pullback area. Plus, when it goes to the lower band, that's a pretty high probability. So here's some of the trades you could have taken with the Perfect Oscillator. This pullback right here is also really close to the lower one, or you could wait for the bar to go back above the 0 right here. It's up to you. If you really believe in the trade, you can kind of buy it right near the lower band, which, if you notice, also happened right here. So you get into that trade right here, and unfortunately this one wasn't deep enough at that time of the day. This is all based on statistics, so we're comparing how big the moves are for that time of the day compared to the last 20 days. And you know, if it's not weak enough during a high volatility normal period, then it's not going to hit our lower band. But it's also wonderful for letting you know when the market's about to stall, like right here. It's at an extreme right here, and it's telling you that it might reverse up there. I'm not saying for you to exit your trade, but you might want to definitely tighten your stops or use exit half your trade and use a trailing stop on the other half. Also, you can use this for divergence trading. Like right here, you have 2 tops. The first one's at an extreme strength. You get a pullback, and then on the next one up, it has a lower high than before. That's a huge reversal signal, and the fact that it wasn't even able to hit the 80 level, it wasn't able to hit our upper Bollinger Band of this indicator, very big reversal sign. So this is a relatively safe place to look for sells. Let me bring it up on some other currencies just so you can see how to use this. Notice again all the times it hits the extreme 80 level. Right here, it reverses up. Right here, the market did make one more move down, but if you're looking to do counter trend trades, or if you are looking at this to tighten your stop, guess what? It only went down a little bit more before a pullback. Right here, did a good job of nailing the low. And then guess what? We made a lower low in the price, but the oscillator is not at an extreme. So what I always like to do with buying the lows is draw my fibs on there, and you can see it came really close to the fib level down there, and the oscillator is not that weak. So when you get divergence, a lower low or a double bottom with higher lows than before, this becomes a relatively safe place to buy once that trend line gets broken from this point onward. And you can also see when this goes above the zero line, the moving average right here. At this point, the oscillator values were more over the zero line than underneath it, because it goes back 20 bars, and you can get into a trade like this and catch that explosive move. So let's take a look at some of the other ones here. Pound dollar. Now this is an explosive move down, but guess what? As it's making a lower low later in the day, we have higher lows than before. And you might, if you're trading this short term, because it's down so much, how much more down can it go? Usually that's a proper way of thinking. If you look to get into a trade here, you might have made 5 to 15 pips. And then on the next wave down, guess what? Not only is it at the lower Bollinger Band, but it also has higher lows than before, and significantly higher lows than before. And you get into a nice little counter trend trade here and get 30 or 40 pips. And it gives you a little warning here that it's at an extreme up move. Guess what? Look at that, to the bar. It's at an extreme, pulls back at an extreme. The market just kind of drifts up. Now, look, it made a higher high than before. The trend's clearly down. This is at the upper Bollinger Band. It's also not at the 80 level, so we have a lower high than before. And the trend's clearly down. You go short, and you make a little bit of money, maybe 15 pips on the counter trend move. And that's how you use this tool. Let's take a look at Australian dollar, for instance. Now this is a big trend down. We always want to draw our fibs on the move, and usually the 38 to 50% level is going to be a decent place to look to go short. You can see this move up right here is at an extreme, and you go short, and it only pulls back about 10 pips. It makes a higher high here with less momentum, and that's a very clear reversal sign. Comes up again, it's at an extreme because it's at the upper band. And then a little bit later, it goes up here. It's above the upper Bollinger Band, and it's at the 80 extreme level. The trend's still down. You made a little bit of money. You have a double top right here with a lower high, and you get into that trade. And I probably would have got out when it went sideways here, but that's 10 pips. And if you held on a little bit longer, you made 20 pips. And guess what? If you didn't know when to get out of this trade, it's at the lower extreme level. It's also underneath the Bollinger Band. The first time it goes back above that band right here, it's a good place to get out, because it means that's kind of that explosive move down is slowing. When it goes back above the lower band, you get out of your trade at the perfect time. So it can be used. This is more for advanced traders. Not every tool I put in the software is going to be for brand new traders. Study up on divergence trading. There's lots of videos on our site and other places online that talk about divergence trading. Usually they'll use the MACD or RSI or something stochastics to show that, but like I showed before, those indicators use periods. They're not based on statistics, and you're going to get probably 2 false signals for every signal that works. And I've been trading with this for the last few weeks. You should probably get 1 false signal for every 4 or 5 winning signals from this when you use it for divergence trading. So that's why I came up with the term Perfect Oscillator. I actually was waiting to release this before I came up with the term, what I wanted to call it. Now here's some of the options for it. If you don't want to show the moving average in the middle, you don't have to. Uncheck this, and the moving average is gone. If you don't want to see the Bollinger Bands on my oscillator, you can get rid of those too. Now personally, or if you just want to show the moving average and not the Bollinger Bands, I like them both because a lot of times you'll see a market move up with explosive strength, it pulls back, goes up again. If you see an explosive, what appears on the chart to be an explosive move, and the perfect oscillator can't even hit the upper Bollinger Band, that's a big sign of not having the strength that you thought it did. Also, if it busts through the upper Bollinger Band, that's a pretty strong move, and a lot of times after the pullback, you can kind of buy the pullback. Even though this isn't a downtrend, if you're scalping, you can get 5 to 15 pips all the time when you see price go through the Bollinger Bands. Without those on the chart, you'll have no idea. For instance, right here, it's so weak that it busted through here, and then it went up. You could have looked for a little sell here, and when you're in that trade, you notice it's just not falling away, so you get out. But you could have, very easily broke even or made even 2 or 3 pips on that trade. When you have a higher high and the oscillator makes a lower high and it's not even able to hit the Bollinger Band, another big sign. So I just find this incredibly useful to have both the moving average and the bands on here. And also you can notice when the bands get really tight after a high volatility, they get really tight. A lot of times that's telling you when the market's in a very low volatility phase, and usually breakouts from those phases are worth taking. You can see another one right here. Guess what? The market went up a little bit. There was another low volatility phase right here. Guess what? The price fell 15 pips. Let's take a look at one last example, CAD yen. Notice the moving average goes from underneath to above right here, and as long as that's kind of above here, you can see this made a over a plus 80 move up. It also shot through the Bollinger Bands. This is an explosive move for that time of the day. Basically looking to buy the next pullback, and you can also look to buy somewhere near the lower Bollinger Band right there, and got you in pretty much on the perfect bar of that pullback. And a lot of times when you have an explosive move up, the market pulls back a little bit more than normal. Let me put my Fibs on here. Whoops. When the market's super strong, I'm going to redraw this. A lot of times it's not going to pull back to the 38%, so we put those old other Fib levels in. At this level and below, it usually becomes relatively safe. You see this dropping, it hits the 80 level right here, almost on that exact bar. What you can do is wait for, and especially use this on range charts, wait for it to go above the previous bar's high, and you're actually long in this trade here at 61 with your stop underneath the low. You're risking about 12 pips, and you can see you very quickly made about 40 pips on the way back up. And again, notice right here, it's at and above the 80 level. It's at an extreme. It's likely to go sideways. It's not likely to continue exploding up at this level. So you look to get out. And if the longer term trend of this one was down and you see this thing's at an extreme, just look to sell when it goes below the trend line underneath the bar's low. And you can pick up, in this case here, about 30-35 pips. And right here it tells you it's pulled back too much. The short-term trend of the day is up. You get out of your short here, you buy here, and that's how you use this. It's incredibly useful, and I truly believe it is the perfect oscillator. Not just because of the Bollinger Bands, but because of the math behind this, the statistics behind this, comparing every currency to its own statistical past. And it's just, I've been working on this for months, trading with it for about a month, with amazing success, and so I decided to release it and give it to our traders.